What's the best way to invest $1,000 into the NASDAQ? Should you go all in right now or spread it out just $5 a day? Today, I'm showing you real world results of two accounts I've been running side by side. In one corner, we have a $1,000 lump sum invested into Fidelity Blue Chip Growth. In the other hand, we have a $5 a day plan into Schwab Large Cap Growth. The results so far are shocking. One is up over 60%, while the other is actually in the red. Let's look at the data to see why, in my case, time in the market beat timing the market. Something to note is that when I started this, I didn't read the fine print like an idiot. Since I'm using a Fidelity ETF on Schwab as my broker, I paid a $74 fee when throwing in my initial $1,000. So in reality, instead of $1,000, I spent $1,074 on my initial purchase. Why lump sum one? For now. In my specific case, the lump sum approach was the clear winner because of a concept called opportunity cost. In the world of investing, opportunity cost is the price you pay for the things you didn't do. When you choose to invest $5 a day instead of putting $1,000 in all at once, your opportunity cost is the profit you missed out on by keeping that money in your pocket instead of in the market. The opportunity cost in this case was Fidelity's strategy, or the $1,000 lump sum, being put into the market all at one time versus the Schwab plan, which was $5 a day. So when I invested the $1,000 into Fidelity on day one, 100% of that money started working immediately. Every time the NASDAQ went up, all $1,000 grew with it. With the Schwab plan, most of the $1,000 is sitting on the sidelines in cash, while the $5 a days are slowly accumulating up to the $1,000 that the Fidelity plan has. The main reason why, in my case, the lump sum investment worked so much better so far is because I started the $5 a day plan much later, so it has less time to mature. But that's only half the problem. I started this strategy, the $5 a day one, when the market was within a percent, I think, of all-time highs, and the market's only gone down to flat since then. So that's why this strategy is down only 1.3%. The math behind these ideas says that the lump sum beats the DCA, or dollar cost average, the $5 a day, whatever you want to call it, about 65 to 75% of the time, because the stock market generally goes up, as we know. By waiting to invest only $5 at a time, and just, I think it goes without saying, but the $5 is just an example for my case. You can do $100, $1,000, $1,000,000 if you want, if you have that kind of money. Anyways, with the $5 a day plan, you're in a way betting that the market would go down, but it kept climbing instead. That's why the lump sum typically works out better. Now let's go over the results. My lump sum strategy, or going all in at once, is up 66% and $713 since July 31st, 2023, while in 90 days, the $5 a day strategy, granted there's only been about $300 invested, is down 1.5%, or like $5. Now, as you see in this screenshot, I'm up 48% on an investment I put $1,074 into. So you're probably wondering how the position is worth $1,700 and the cost basis is $1,200. That's because of dividends, share reinvestments, and capital gains reinvestments. These are exclusive to mutual funds. A dividend, I'm sure most people know, is a very common thing among stocks and ETFs, is a portion of a company's profits paid out to you just for simply owning the underlying asset. Share reinvestments are typically similar to dividends. Sometimes instead of paying you in cash, a company gives you an extra piece of the company directly. Then there's capital gains, which is what I was referring to when I said it is exclusive to mutual funds. When the fund managers sell a stock inside the fund for a profit, they are legally required to pass that profit on to you. Now the math with within mutual funds on Schwab is weird. I don't know if all brokers handle these dividends weirdly like Schwab, but Schwab doesn't like to factor in the dividends and capital gains and all those reinvestments we just went over for some reason. But as you can see, I'm up more than 48% on this position, and that's just the share price appreciation. That doesn't factor in these dividends and other things. This is, in my opinion, why mutual funds are better than ETFs regarding the capital gains reinvestment, of course. But only if, the big keyword if, you aren't an idiot like I was and don't pay a ridiculous 7% fee or whatever it was that I went over earlier. Here are my screenshots now of the Fidelity and Schwab mutual funds. The main thing I want you to take away from this, specifically if you're new to investing, is that this is a tortoise and the hare scenario. Investing in the stock market, whether you opt for the lump sum or $5 a day strategy, will not make you rich overnight. But if you stay the course and don't blow up your account with options or penny stocks, you can and will reach financial independence in your future. As you can see, the Fidelity Fund has paid me $126.56, which equals out to about 6.67 shares. These are shares that I didn't pay for. I didn't lift a finger. All I did was spend 30 seconds of my time 2 years ago. It's that simple. Now, the Schwab one is a little less exciting, of course, since I've only been doing the Schwab fund or $5 a day strategy for about 90 days and have much less money invested, obviously. I've only received a measly 81 cents. There's not much to go over here with the Schwab one, obviously, but in the future months and years, I believe this one will grow and eventually surpass the Fidelity investment. And I'll go over why I believe that in my next video as a little teaser, I guess, for what that video will be about. But for now, I'm going to go over both these individual funds, and they're almost identical, but not quite. Schwab's funds top 10 holdings make up almost 61% of total holdings, while in Fidelity's top 10 holdings make up 63% of the fund, and the top 5 in both make up just under 50% of the total holdings. Something to note is that these numbers could change and probably will change in the future. So if you're viewing this 6 months, a year from now, don't expect it to be identical, but it will probably be similar. As we can see within the holdings, their numbers are similar but not the same, with the Schwab fund being slightly more diversified than Fidelity. However, I wouldn't make your decision on which one to choose based on that, because they're both tech heavy. So if you're looking for diversification, these are probably not the right investments for you. I would just stick with the S&P 500, since you're getting all the exposure to tech with the additional diversification of heavier weighted financials, consumer cyclicals, healthcare, etc. So is lump sum always better? Mathematically, usually yes. My Fidelity account so far has proved that by catching a 48% move with the full $1,000. But the $5 a day Schwab plan is not a failure. In fact, it's still a great strategy. It's just different. While I'm down 1.3% on that one today, I'm also buying shares cheaper than I was a few weeks ago. If the market crashes tomorrow, my $5 a day plan will look like a genius move, while my lump sum plan will take a hit. The real takeaway, if the market is at or near all-time highs, I would personally go for the $5 a day strategy. If the market is in a dip or down 5, 10, 15, 20% or more, I think your best bet would be doing the lump sum. The reason for this is it will possibly go down further. You're very unlikely to catch the exact bottom. But let's be honest. This economy always recovers. It always has. And if it doesn't, we've probably got bigger problems on our hands than worrying about some money. So the best strategy, in my opinion, is the one that gets you to start investing. Whether it's $1,000 at once or $5 a day or even $1 a day. Just getting your money into the market is the only way to win long term. So that's all I got for today. Thanks for watching. If you enjoyed, don't forget to subscribe. and let me know your thoughts in the comments. All right, thanks guys.